Hello everyone, welcome to Fearfully Greedy. In today's video, we'll go across some insurance research, insurance companies. It's something I've always been interested from the big guys that they love these kind of companies, but they seem a bit like a black box, hard to get into. So I said, let's take a look at the 126 companies and see what I can learn in a few weeks. This and all my videos are not to be considered financial advice. I'm certainly not your financial advisor, so please get one or do your own research. I also might be wrong. Also, the data I use might be wrong. So, yeah, no liability for me, please. Let's go ahead. First, just to go to the basics. So, insurance, the business is very important because like someone has a risk, like I don't know, car getting hit, your building getting burned, or something like this. So there's a contract, an insurance policy that you make with the insurer. You pay a fee that is periodic, and then that risk is offloaded to the insurer. That risk, the fee that you pay is a premium, okay? And the idea is this exists because, let's say you have a car and you have $7,000 saved, and your monthly salary is $3,000. Let's say that car gets completely totaled by someone else, by someone else, so it's not like your fault. So it falls within that risk, and let's say it's a 1% probability of that happening, but you lose $20,000 to get your car back in order or to get a new car. So that will certainly bankrupt you because you don't have the cash flow or the savings to pay for that. Then what happens is the insurer comes in, they get 100 of you, and then they take all those premiums, and then they take all the risk. So I said it's 100% risk of losing those $20,000. This is a simplification, but please follow along. So that's 100% probability of losing $20,000. The only thing they have to do is charge over $20,000 across that period of coverage, right? So that's the insurance business. No one gets bankrupt. You pay a bit more, but no one gets. It's a social. It's very useful for social life, right? Because no one gets bankrupt. You are safe, something can break. There's bad parts of it, like you know where you are covered, so you take a bit less care in your life, but that's why premiums tend to be higher than the real cost. But yeah, it's a good thing, okay, insurance. Then there's the investment income side. But first, how do they make money, okay? Okay, aggregate premiums and investment income has to be over those $20,000, okay? Simplifying and just to make a quick explanation of it. There's also the concept of float, okay? So there's an initial policy and then the final payment. So to cover the risk, if there was, let's say, like n number of policies, at the end the payment should be close to that number in general, okay? But we're at the first period, so at the start of that. At the end, there's the payment, let's say, okay? Since the float, when you start, so you start to keep coming these payments in, you build some money, okay? At the end, that money leaves. So float disappears. What we need is renewals and then new policies coming in, so that the float stays up and you have some money to reinvest. That's how down at this end of period, you still have the same float, right? If everything stays constant. Then we can have investment returns, because we can take that money that we know we won't have to pay. You need some to keep paying and keep getting paid and everything, but you have some that you really don't need, in a sense. If things keep going, right? Depending on how good your underwriting is, you are getting either cheap or free, or you even get paid to receive that money to invest, right? That's the cost of float, let's say. If you have good underwriting, you will get some money on top, even after the float. There's, for example, health insurers that life and annuities and that they make most of their money from investment returns. There's other kind of insurers like car insurance, auto, passenger car, that they tend to make very little on investment, because at the end of the period they tend to not get much, right? But what they do is very good underwriting. Okay, so they charge more, like a good margin, on top of the real cost of the business, of that risk. How can they make more money? So it's either more premiums or more underwriting, like better underwriting means cheaper money, so you get more margin. Or you can do more investment income, but that also comes with more risk. Like better investing is better risk-adjusted returns. And that is even tougher, especially long-term. Like seeing all these insurers, for me it's very hard to tell who has a better investment, I don't know, office, right? I would say none of them or all of them, because mostly is fixed, right? Fixed income. Kind of insurance businesses, okay? Let's say there's life and health, that's property and casualty, and there's reinsurers, okay? Life and health, let's say you pay life insurance. At the end, if you die or something happens to you, your family will get paid. There's some annuities here. You also pay across your life, and at the end you get paid after some years. There's pension, there's, how do you say, worker compensation. There's other kind of things, but it's not like something breaks, okay? Property and casualty is something breaks, something gets damaged, and you want to get covered for that, so you don't have to pay it net sum. And reinsurer is either, because they're reinsurer of property and casualty, they're reinsurer of life and health. It's people that say, okay, you don't want all that risk in your books because maybe you don't have enough capital, so I will offload some of it for a bit less than the premium. So they take a cut on the premium, but they take a good look and they say there is still some margin here. So let's say the premium is $100, and from those 100, if we simplify, okay, the coverage is like 80. Okay, so the reinsurer will say, okay, pay me 90 and I will take care of the risk. Okay, simple. In general, very general, okay, each case is unique, but underwriting margin is lower in life and health. Underwriting margin is higher in property and casualty, and also higher in general in a reinsurer. Higher, okay, not high, but higher. Investment income is higher in life and health compared to property and casualty, and reinsurer is like a middle point. Assets, life and health tend to have more assets because they kind of build this float across time, this risk across time. You pay for 30 years your life insurance, then you die, or 50 years, and then there's a big payment at the end. Okay, they have less assets in general in property and casualty, and also less in reinsuring. Leverage, it's higher in life and health, it's smaller in property and casualty, and middle of the road in reinsurers in general. Okay, valuation to book tends to be lower in life and health and higher in property and casualty. Reinsurer also lower. Same thing. To premium, like to revenues, it tends to be lower for life and health and higher for property and casualty. Okay. Okay, let's take a look a bit on P&L. Okay, just quickly, right? Nothing crazy. Okay, there's first new policies go on the liability side, so it's unearned premiums. It's only at the end of the period that you kind of recognize those. They build up in the cash and cash equivalents, and then at the end you have the direct premiums you have written, so that amount. All the policies sold during the period, amount agreed to be paid. Then is the change in unearned premium. So you had the unearned premium from previous period, then an unearned premium at the moment, and that's the difference. Okay, and then so that's in the balance sheet side. So there's a few moving parts. Okay, but just to get a grasp. Okay. I wanted to show you an example, but okay, we can see that unearned premiums was 1,042,000, that's probably a billion, but 1.042, and then before was 954. That difference, okay, goes into here. this period. This minus this should be this, right? If I'm wrong, I'm doing this over the presentation, so, but that's the math. Take a company and do it yourself, okay? See if it's correct. But I did the math when I did the presentation and it should work, okay? Yeah, okay, okay, I put it here. 954, which was the previous period, minus 1,042,282, or whatever. That's probably millions, or thousands, I don't know. The difference, and it's what you have here in revenues. So this is balance sheet, this is P&L. Okay, let's go. Direct premiums earned is the premiums recognized that they have made, right, at the end. You have to know that you can seed those to reinsurers. So that business that we say, the third bucket, you can seed those business and they will be subtracted here, okay? And then you get the premiums earned net. That's what they use for the research, okay? Total premiums that the company recognizes as earned through the period. This might be a bit confusing, so it's better that you take a P&L and you check it on the site, okay, yourself. Net investment income, okay, it's adding the investment income on the current float of the company during the period. You can see net investment income. Sometimes it's, well, you can see here that there's some recognized, some not unrealized, depends on if it's equity, if it's you sold maybe the fixed, like the bond, all those things. But it's the three things altogether. That will be the investment income that I would say. There's also commission free fees, because there's sometimes a third party that does the underwriting and then you buy it from it, or maybe you do it and you kind of put it in someone else's book. So like for example, reinsurers might pay you some commission revenue. There may be some policy fees, let's say, I don't know, if something covers this amount, but then if you don't pay something, or something is, I don't know, maybe after every fifth year there's some policy fees, something like that, okay? But it tends to be a small amount. And then the total revenue. So we add all of these up. Then losses and loss adjustment expenses. It includes all costs incurred during the investigation and handling of claims, and including settlements. So it's like taking care of your risk, the risk that someone else insured with you, so we're the insurer. It's taking care of that. That's sometimes checking on the house, that's legal fees, that's the final payment, that's all those costs, right? And then general and administrative fees includes all costs incurred during the period to run the business other than claim related. Okay, like it's probably headquarters and other things if there's other lines of business. Okay, what I did, my research. I took a look at 126 insurers from around the world and took the records for the last 7 years of financials from each one. Some companies have been running or public, so we have public numbers for less than 7 years. I also did my best to have accurate data. The data is over 5,600 points. I tried to correct it all also at the end for the ones that I really like, that seemed really different than the other 120, okay? So, as I said, this is not your research, it's my research. It's free on YouTube. Don't expect something that, like this kind of research with better pamphlets and some like a better, like someone that has a better reputation maybe. You would pay thousands, okay? So it's okay. For me, it took a few weeks of thinking about it and just taking the numbers down and doing some numbers wrong. First, I took the premiums earned, okay, also the investment income, right? Then other income also, all other revenues, losses and loss adjustment, so whatever it was to cover the risk, and then the general and administrative expense. With these numbers, I did some ratios and some things, okay? The loss ratio is losses, claims, and reserves divided by premiums earned. What was the difference between the money coming in through premiums versus going out just to cover the claims? How good an underwriter are you? Okay, I want to find the average and the top 50 and discard the rest. Okay, so I just kept filtering first with the loss ratio. Okay, and this is the loss ratio for the top people. think about something. There's some lines of business, like it's title insurance, mortgage insurance, that they have very different numbers. You see this is very low, and they have more on the expense side. So I tried to correct for that later on the combined, but okay, this is the loss ratio. What difference between premiums and coverage? The average was 83.48% loss ratio, and these are the top ones. Later I corrected some of these numbers. Okay, so some of these numbers changed a bit, but at the end I corrected for them. Okay, so don't worry. My expense ratio, so that's what I did. I did expenses and other expenses other than claims, and then premiums earned, so divided by premiums earned plus other revenue. Usually I think people don't add other revenue, but I did because I think expenses other than claims also cover other revenue, so to make sense to someone else, maybe not. Other than covering claims, what were your expenses compared to the revenue coming in operationally? How good an operation you have. That's scale, also efficiency in the business. That's some of those things. Okay, I want to find the average and the top 50. Maybe it's not top 50, but where we took out all the previous ones that were not in the list, and I tried to only keep these ones in the list, and if the ones were going under the previous ones, that also go out, right? If they are not good in the expense ratio. The ones that are blue, it's just that since they have other lines of business, so their loss ratio is low, their expense ratio tends to be a bit higher, but they tend to also still be a very good business on the combined ratio, okay? But the average was 35.92% expense ratio. Okay, combined ratio is adding the two together. How profitable is your underwriting operation overall without taking into account investment income? How profitable is your underwriting? I want to find the average and the best ones, okay? Combined ratio across the 126 companies was 110%. That means that mostly lose money on the underwriting side, okay? I like to see people or companies that they generally make money on underwriting. Like they are an underwriting business, they are an insurance company, so they should make money. But still, a lot of the health insurance, if you see there's none here, health insurance, that's because most of them lose money on the underwriting, and then they make it on the investment side because they have a big float, okay? But they rank them. And now I will try to also add price into the mix. Some of these business models, especially mortgage insurance and title insurance, make it a very different business and the margins, but with other pros and cons. Of course, this is just overall research with adding just the report numbers, but each one of these is a real business with a lot of people working there, which its own idiosyncrasies, and maybe have investment in other things. So you will have to go one by one, okay? Then I did my valuation metric, which looks like a lot of numbers, but I tried to do a super combined profit ratio. To simplify, I just added investments into the combined ratio, okay? I add investments, but then I add all expenses also, okay? Then the theory earnings is taking this ratio with the last 7 years of revenues, so like average last 7 years of revenues, but then the trailing 12-month revenues on top, and we do the average. So we do the between the last 7 years and the last year, so we have more recency. So we bring it more closer to today, and then I do like a P. Okay, so but it's not P because it's not price; it's enterprise value. So I want to see debt also built on top. Book value should also be taken into account, as for example, life and health insurance has little margins on the front, so mostly you are buying the book and it should be priced below book, as returns tend to be worse than equities. There's no life and health on the final list, so don't worry about it. They tend to be pretty bad business. If you ask me, ask someone else, maybe they have a different opinion. But how cheap is your insurer? Let's try bringing price into the equation, all 7-year average. Okay, that's the result. So we have Grupo Catalán Occidente, so that's Spanish company, like they work in other countries too. But then you have auto home insurance, Fidelis. This is a kind of a unique business that you will see it will be kind of one of the cheapest ones at the end. But yeah, there's a wide range. Runoff Insurance, for example, is an insurer that they take insurance lines that other insurers don't want anymore, and they take like the last tail of it, like because they are not writing it anymore, and they just don't want to be in that business anymore. So they take it and they buy it probably for cheaper, and well, it's a different line of business. Okay, worker compensation. There's property and casualty, a lot of that, but mortgage insurance is very linked to home, like the building market, like home building market. So it's very linked to that. I don't know if I'm a super big fan, okay, but if you see there's quite a difference in like enterprise value to price, okay, there's no growth ratio. I will add it also at the end, but this is I don't know, a bit of the result. Think about it, I did 126 companies, so it was a lot of data points. Probably between here there's something interesting. I don't know which one at the moment. We'll have to do more research after this, but the real research starts here. We just found what might be interesting, but most likely everything here is cheap for a reason, or as you see here, it's not cheap at all, right? And now it's your job to find why it's cheap. If you can find it, like why it's cheap, then maybe you have found an investment. But the work starts now, okay? Then I did an alternative valuation metric, which is enterprise value on common equity. So it's trying to value them by book. You can see that Fidelis is also on top, Grupo Catalán Occidente is also on top, SGR and Star is also on top. And these two tend to be very cheap in both, right? Very cheap in both. They tend to have a very good combined ratio across the last years, way above their peers. Once I have taken a bit of a look inside of all of them. As I'm talking now, I have not invested in any of them, okay? I might hold the video. This is recorded on the 30th of December. I might post it first week of January, because maybe I invest in some of these, but I need to do a bit more research. But these two here, for now, look interesting. What I will do now, is just doing a DCF on all of these companies, adding in like shares, adding in growth, mostly growth, like revenue growth, like how the curve is looking, if they're trying to be very flat on new policies, if they are growing policies, because that's a big driver of valuation. So here we just have like a photo today and really no idea of the future. A lot of in the past, who has done good things in the past, they might keep doing that, but we don't know if the book is growing, if the book is getting smaller, okay? That's why here we have probably high valuations, because they tend to grow more. But okay, let's take a look here. So I did the DCF, and also I added all of this to my watch list to keep an eye. And what I did is a rough valuation, DCF valuation, and I compared it to the price, the share price, the share back of the envelope valuation after a DCF, where I took the last 10, 5, and 3-year growth rates on revenues, on premiums. I corrected a few mistakes also, like on Catalán Occidente, they had kind of a one-off year. Fidelis also had like a one-off year, which I have taken out. Still, it's the cheapest, and it's cheaper by a lot, right? So I will really take a deep dive on Fidelis. Probably the next video is about Fidelis, and maybe if you see the video I have invested, but will be another video. For now, I have not invested, okay? And if I have invested at the moment of posting the video, I will pin a comment, okay? I will pin a comment and say that I have invested. Let's do that, okay? Because I want to be transparent on the portfolio. Still, no investment and buys, but probably it will be a separate video analyzing if this company really goes into the books, it really goes into the portfolio, because probably I will have to sell something or adding some cash in, we'll see. But that's the research for now. that's pretty much it for my end. I hope you liked the video. It took a few hours, I'm not gonna lie. Also, the first quarter is terrible for me. I don't have much time in my day-to-day job. The business I run, it's a lot in the fourth quarter. But on a few hours here or there, I was thinking about this, and I think it's a good research. It puts some eyes. There's a wide diversity on valuation, on underwriting. Like, not every insurer is the same for sure. And yeah, I think some of these companies might be an interest to you. Okay, and here is the margin of safety. Okay, so the difference between what I think they are worth, or what the DCF gave me, to the current price. And a lot of them tend to be cheap. Also, I ranked them on cheapness before, right? So that's why they are here. But it looks like not overpriced, like at the moment. Maybe have to correct a few things, and maybe I'm a bit... The portfolio sits currently on 89,000 euros with a 49,000 euro gain, which is 122% over initial capital, which has been 40,000 euros across the last 4 years. So a bit over 4 years, the portfolio has been going on. At the start of the year, I also like to do like a year review. So we'll see the performance across the last year. It has been very good thanks to Carvana. Carvana has more than doubled, and it's close to 60% of MAP, right? So it's a big investment at the moment. I think the Carvana story is still early and it's still very ripe. The margins, like they are just killing the competition, and they have 1% market share. So the sky is the limit. Some of the other companies in the portfolio, I'm a bit not disappointed, but yeah, the thesis has not transpired where it has. Next year we'll start to see revenues from the new positions. Playmates, we should see what the management likes to do with this extra cash. We won't know much until the start of the year on the final numbers for the year, but they should be good. They should be good, especially also next year and the end of the other year. So I'm not worried here. Like, it's very cheap at the moment. Naked Wines, the new management is trying to turn around the ship. I believe a lot in the thesis. I've done a few videos. Pax, great company. Top of the food chain in POS, I think, in the world other than China. And they just had a pretty rough 18 months, right? It's been not that great on revenue growth, but I think they should get back to growth soon as more payments become electronic. Baba, it's back to business, but the valuation is not showing it. They are buying a lot of shares back. Naga Corp is a company that I might add more to, because I think the story, especially in the next decade, looks very nice, very good. And Rai is showing a few good contracts that might turn around. Here we're 70%, I'm 70% down, okay? Remember, there's a link in the description where you can check it on the Google Sheet, which is live prices and the last buys. And whenever I buy something, the next day I always put it there. I don't buy a lot, so don't refresh the page a lot, because there will be nothing. Okay, Happy New Year. That's all for me. I will see you in a few weeks, probably. Okay. If you liked it, please like the video, subscribe. It's appreciated. Okay. Bye bye. Take care. See you.